afternoon. It's 4 o'clock. We are the Price Group, and welcome to our webinar, Tax Strategies for Retirement, 10th of March, 2021. Rather boring subject in a way, but a very important subject. We're going to try to give you a lot of information, leave time for questions, and make sure no one goes to sleep if at all possible. So who are we? We are the Price Group. We're a fiduciary-centric investment team. We're passionate about the need for a wealth coach. That's our tagline. Everyone needs a wealth coach, family-owned and operated. 40 years of experience. We are a fiduciary, and we serve a retirement group. 90% of our clients are either retired or retiring in the near future.
A little bit about our firm. Steward Partners is the name of our firm, based off the biblical definition of stewardship. Randy mentioned we serve as a fiduciary, over 23 offices across the country. Here in Houston, Austin, and Dallas are our Texas locations. We utilize Raymond James as our custodian and back office. And so clients receive a Raymond James statement. They are a vendor of ours, and they've been an A-plus partner to help us serve clients here over the past number of years for that. So should you listen to the Price Group, we've been really humbled and honored to receive a number of awards from Barron's, Forbes, Financial Times. I'll draw your attention to the bottom middle logo, the Wealth Coach Podcast. We put out a weekly email, many of you which probably are already receiving it, but we have a number of short 2 to 3 minute video podcasts that we will publish on a regular and consistent basis, something that our Client Advisory Council has given us the kind of feedback to have more video content for our clients. And then Randy and I, we both attended University of Wharton to receive our SEMA designation. I think it's very important to be credentialed in our business, which we both are.
So today's agenda, let's understand the current landscape. Let's also get into planning considerations and strategies. Again, things that you can take from this webinar, helpful hints that will make a difference in your financial life. Understanding the current landscape. Okay, here we go. Locked and loaded. So really where we are, we have a favorable income tax environment for most people. Marginal tax rates are still lower than they have been in the past. There's still ability to deduct, to itemize your taxes, if you will. The standard deduction is higher. The standard deduction is if you don't have enough things to itemize, you can still take off your taxable income to reduce your taxes. The AMT, or the alternative minimum tax, is no longer an issue for most of us. And we have right now a very favorable estate and gift tax environment. But a lot of you all were thinking, hey, there was a change in some of the people that run the country. What about the future? We're going to talk about that. There's some uncertainty about income tax rates after 2025 because some of the tax reductions do sunset. So again, it's an environment where you need to be paying attention, especially if you are close to retirement or on the line between what could be changed under, quote, new law, unquote.
So here's a few key figures for this calendar year. There's been some talk on will the Biden administration make changes that are retroactive to January 1st of this year. Our gut says no, but it is possible it has been done in the past based off the fact that the country is still coming out of a recession. The Federal Reserve and really every branch of government is doing everything possible to try to promote growth. We think it'd be unlikely that they would do it for this year. We do think probably 2022 we see some type of tax change, but let's see what happens there. So a few things to note on this page. You see 0% long-term capital gain. You can actually have a 0% long-term capital gain on, if you're a married couple, up to round numbers about $80,000 worth of income. That's a huge planning tool that we'll utilize for clients. We'll see a lot of clients in the first few years of retirement possibly have a reduction of income, and utilizing this is something that we do talk a whole lot about. Something else to mention here, the standard deduction. You can see this here, a little over $25,000. Standard deduction just meaning you get that as a married couple for $25,100 if you do not itemize your taxes. Itemized deductions could include charitable gifts, property tax up to $10,000, and a number of other things on there. So we'll talk a whole lot about bunching your deductions. So maybe every other year you utilize the standard deduction and you would make gifts to your church, charity of choice, whatever it might be, in, let's use 2021 as an example. You do your 2021 gifts throughout the year, and then for 2022, you would just make the 2022 gift actually December of 21. And so it's a way to itemize every other year and potentially save some on taxes along the way.
So we've got a lot to take a look at with regard on income taxes, also on estate taxes. Potential for change there also. Your estate tax can range from 18 to 40%. You have 11.7 million. You can pass that on without any gift tax or inheritance tax, any estate tax. Obviously, if you're married, you could double that, and therefore it is a good way to pass money on to the next generation. You can also make gifts up to $15,000 per person per year. Husband and wife could give 15 plus 15, $30,000 to a son. Plus they give 30,000 to a daughter, plus they could give 30,000 to a cousin or an aunt, brother, uncle, whatever. There is a term you might have heard used in the estate planning, portability. Even if you have a relatively simple will, no bypass trust, you can still get the double lifetime gift and estate tax exemption. Your will just has to have some common language, some language in there. And again, the attorney can help you with that. But as Matt talked about a little bit earlier, there's been talk, especially on the estate tax, of limiting the amount that people with assets over $5 million can pass on with historically fairly low estate taxes. The estate taxes, again, now about 40%. They've been much higher in the past, and that amount that you could pass on started out at 600,000, worked its way higher, and again, very, very much higher than it started, but that is subject to change. So again, stay tuned. Some people may need a new set of wills. Other people may look at doing gifts if the law is going to change next year, making some completed gifts this year. In fact, we've had some people scramble to get gifts in to know where they for sure can make those gifts without paying potentially higher estate taxes. So again, all part of the planning process with regards to what we got going on. The Secure Act, interesting name for a tax legislation as well, but made several changes to IRAs. Under the old law, if you will, you started your IRA, you had to start taking money out of your IRA, didn't have to spend it, but you had to start taking money out at 70 and a half. For folks that fall under the new law, you now can wait until age 72 before you start taking money out of your IRA. That's a help. The hurt was the repeal of the stretch IRA. You pass away with an IRA and leave it to your heirs, and let's say those heirs are your children. Those are what we call non-spouse beneficiaries. They now must liquidate that inherited IRA 10 years after death. You don't have to take anything out year 1, year 2, year 3, etc. but by year 10, it all has to be emptied out. Under the old law, you were able to take out a small percentage each year, and the children, if you will, the grandchildren, could stretch that IRA out and therefore use Uncle Sam's money for a longer period of time. So the government giveth, the government taketh away. It may push heirs into a higher tax bracket. And so the repeal of the stretch IRA makes income tax planning, if you've inherited a IRA from a parent, et cetera, even more important. Should you take out 1/10, or how do you factor in the income from that and coordinate your deductions and make sure that you don't give Uncle Sam more tax money than you needed to be? So again, things that tend to change, and they are changing. Could we see more changes? They've talked about increasing the required minimum distribution to age 75. They've talked about additional catch-up contributions at age 60. The big help, again, one of the good news portions is you can make a qualified charitable distribution now. If you're over 70 and a half, up to 100,000, we're talking about increasing that as a way to funnel money to charities. And employer match for qualified student loan payments is something else that's been talked about. But as much as these things are being talked about, we'll believe it when we see them coming. So anyway, that is part of keeping your eyes forward and your finger on the pulse. A lot of clients ask us, well, what are the possibilities of higher income taxes? People are worried about that. Changes in the political landscape following the elections. As we talked about there briefly, the expiration of some of the tax provisions that sunset at the end of 25. Then, of course, the government keeps spending more money than they're making. So you would think at some point there will be some pressure for income tax rates, capital gains tax rates, maybe even estate tax rates to go higher.
So here's like Randy mentioned, there are some pressures to increase revenue from a country perspective, just based off the annual budget deficits that we have seen. There's really three ways for our country to get out of debt. Number one, you can tax more. Number two, you could reduce spending. Or number three, you can inflate your way out of some of the debt. Borrow money now, pay it back with dollars that are not as usable in the future. And if you look back at World War II, it was a combination of all three of those, of how the country paid back a lot of the debt after the Second World War. So we get a lot of questions about the Social Security Fund being depleted. The Biden administration has said that if there are any tax changes, no one making less than $400,000 for a married couple would negatively be impacted. That's not completely true from a standpoint and it's not really in the actual tax law proposal, it being a separate Social Security tax law proposal. The Biden administration would say they want anything for people over $400,000 to have an increase and pay the Social Security tax on any income over round numbers 400,000, while at the same time rapidly increasing the max of which you pay Social Security tax. And so in a period of about 10 years, you'd be paying Social Security tax on everything. And so anyone making the number this year, I think, is about $140,000 on what you pay for Social Security tax. So anyone making over 140 could still be negatively affected from that. Potential income tax increases being discussed. They're talking about bringing the highest marginal tax bracket back up to 39.6%. They're also talking about taxing any income over $1 million as ordinary income. This would be a big change for a lot of business owners. We just briefly mentioned the Social Security payroll tax changes that are being talked about on there. And that last one, the limited step-up cost basis at death, this one's kind of peculiar, and I don't know how it would be implemented. We'll have clients who who have owned a stock for 20, 30, 40 years. They're not sure where they bought it, how long they've had it. And when one spouse does pass, you get a step up in basis as the law currently reads. If you took that away, it'd be really hard to prove or assign a cost basis for stocks that have been held for a long time that you haven't necessarily kept good records for. We work really hard to keep records for our clients. The times we've seen this are when someone's bought something prior to utilizing our service. But that's one that kind of a lot of people raised one eyebrow at and kind of thought about. But yeah, like Randy said, wait and see, but it will be nonetheless halfway interesting.
So we've thrown a lot of information out. Hopefully it is helpful, it is useful. And with our ear to the ground, not exactly sure what's going to happen. But again, we think this sort of is the foundation for what we like to see with our clients, and that is the planning process should lead. And it's especially important to be about planning when we're in a period where changes may be made. So it seems like the tax law is always changing, but we could see bigger than usual changes. And so again, how do those affect you and your personal situation? What possibly should you do different? And let's talk a little bit about that as far as an actionable plan strategy. We want to maximize some of our popular deductions. We've talked a little bit about taking advantage of lower tax brackets. For example, if you're retired and you have a lot of money outside your IRA, you say, well, I may as well just live on that money and let my IRA grow. Well, that's true to a point, but how about a strategy of using up some of the lower income tax brackets, the 0, the 10%, the 12%. We joke with our clients, it's almost a privilege to pay taxes at 12%. If you don't need any income of that IRA, you could possibly do a Roth conversion where you wouldn't pay taxes on a portion of that IRA. So again, thinking outside the box a little bit to do that. If you're less than 59 and a half and want to retire, there's a way to get money out of your IRA without paying a 10% penalty. And we'll use that to, if you will, bridge the years if someone retires at 55, 56, and bridge the years from retirement until 50, 59 and a half. So the income tax planning, even though it can be, again, boring and seem like it doesn't make sense, we work with the client's CPA and make sure we're taking advantage of deductions, bunching deductions, looking at ways to minimize that impact, because if you pay less taxes, obviously you take more money home. Estate planning under the new law, it's a good idea to have a wills reviewed on a regular basis to make sure they're up to date, the people that serve as executor trustee. But under the new law, hopefully we get to keep the step up in cost basis, and you perhaps, if needed, are making some annual gifts, planning as a result of the Secure Act. So lump sum charitable gifts. If you are making annual gifts in years and not getting uses of that, in other words, because your what we call your standard deduction is greater than what you are being able to itemize, maybe rather than doing 10,000 each year, you make a gift of 30,000 and have that gift for 3 years. So that's a great strategy of that. By the way, SALT stands for state and local taxes. So you live in a house and you have $20,000 worth of property taxes, you can only deduct 10,000. We used to be able to deduct sales tax, we can't anymore. And again, working with your CPA to determine maybe bunching or lumping some charitable gifts, or as Matt said, payment of some property taxes in order to get over the standard amount. It can really save some money. Those are hard dollars, guaranteed dollars saved, and obviously the charity would probably be happy if you could accelerate some of your gifts as well. So again, one of our very popular is lumping the charitable gifts into to a single year.
And one other piece, that the way that we do this is through the donor advised fund. So we'll see clients that will receive a severance package, some non-qualified deferred compensation, and so their last year of employment is a big income year, and so utilizing a deferred or donor advised fund, a DAF, a DAF, some people will refer to it as, you can itemize now, gift later would be the Reader's Digest version, but you can put it into an account, invest in stocks, bonds, mutual funds, ETFs, and then gift down the road to your charity of choice. The stipulation being it just has to be a qualified 501c3 organization on there. So donating IRA assets directly to charity, we briefly mentioned this earlier, have to be 70 and a half to do this. Currently the law is at $100,000, and this can actually offset up to $100,000 of your RMD, your required minimum distribution. This is the best strategy for most retired clients from a standpoint, you're not having to pay ordinary income on the money that is going out from the IRA to the charity. So we do this for one, maybe 2 dozen clients each and every year, sending money to their church, charity of choice, to offset a portion or in some cases all of their RMDs once you reach 70 and a half. Like Randy mentioned, the new rule though, the required minimum distributions actually don't start until age 72. So a little bit of a difference there. But looking here, the lower tax rates benefiting a Roth conversion, a great strategy for someone that might not need the income, that might have a lot of after-tax dollars, but to utilize some of the lower brackets will choose to fully use up the 10%, the 12%, and even sometimes into that 22% bracket, and use that and put it as a Roth conversion in there. You know, Randy is making 100% of his 401k contribution to a Roth 401k. I'm doing the same. That doesn't mean it's right for you, but what that does mean is that the Roth is a very, very, did I say very, valuable planning tool in retirement. And so if you're looking for a way to just show income but you don't need income, that Roth conversion can be a great strategy to consider.
Matt, probably a good time, we probably maybe should have said this a little bit earlier. Anything that we talk about here as far as tax planning, these are tried and true things that work, but anything involved in your tax planning, it's a great idea to consult with your CPA, or if they're estate planning, to consult with your board certified estate planning attorney, just to make sure they buy in. It's a partnership, and again, it's better to talk to those professionals before you do this, to coordinate and to make sure your situation is not different in some way, as opposed to, whoops, I shouldn't have done that, and have to try to undo it.
Yeah, great point. So here, looking, the Roth accounts are ultimately a hedge against the risk of higher taxes, which sounds like for some people that might be the case moving forward. 2 different strategies here to consider to get more money into Roth accounts while you're still working. Number 1 would be a backdoor Roth contribution. And so explain just briefly how it works. The strategy does not work that well if you have another pre-tax IRA out there, and I'll explain more why in a second. But what you can do is you can make a non-deductible IRA contribution, and then the next day you can do a Roth conversion from that account. You would owe ordinary income tax on any gain in that account, but if you made a contribution on a Monday, you did the conversion on a Tuesday, you wouldn't have any gain in there if the money was just sitting in a cash or a money market And so with that being said, that is one strategy to get some dollars into a Roth account, even if you're phased out from the income, top amount you can make and put money in. The second thing to consider, which won't work for everyone, it depends on your 401k provider, but you can make an after-tax contribution to your 401k, and then at retirement, you have the ability to roll those after-tax contributions into a Roth IRA. So 2 strategies to do that. That's on top of the one that everyone's probably familiar with, just the Roth 401k. There is no income limit to add money to a Roth 401k, but there is with a Roth IRA. So I know we're using a lot of acronyms here, but some salient differences between the 401k and IRA. One of the big ones has to do with the phase-out limits for adding to a Roth on the IRA side, but not on the 401k side.
Again, as part of our considerations, when we sit down and talk with clients, we want to review a lot of this that's going on, and it's not too soon to be doing Roth. Maybe Roth IRA or 401k makes sense, but better to ask now than 5 years from now. Think, well, I wish I had I'd taken a look at that. So let's talk about the boring state tax considerations. Actually can save money for the next generation, so probably not all that boring, but review of your estate plans to determine if changes are needed. A lot of people tell us they have 10, 15-year-old plans. They've named someone as executors. Maybe that person has passed or whatever. That is an important review on a regular basis. How do you deal with low-cost basis property? Ensure that its stepped-up cost basis is maintained when the property is transferred. For example, if property is owned by a trust, it can run into problems with getting the step up, where if that trust asset has been distributed to the person, it can get a step up. So that's a little technical, but again, asking an attorney can sometimes help save some capital gains tax. If you're a high net worth family, you may also want to consider a gifting strategy. Gift now, or you can do the $15,000 a year as we've talked about. You might want to use up some of the additional amount in order to make sure that it doesn't get taken away by a potential law change. You do it now, it's done, it's sealed, and it can't be undone. And as we said, an estate planning professional can talk to you about your exact situation and what might be the best for you. But again, we see people all the time that just haven't gotten around to doing a will. And last time we checked, everybody's going to need one. The more important document than the will could be the durable power of attorney, where someone is incapacitated. So those are good considerations, if you will, looking forward to making sure that you're taking care of. So we've talked a little bit about this, but before the law sunsets, you're a high net worth family and you have the ability to give some money away. You might want to do that now because of the fact that, again, the tax law changes automatically now in 2025. That's what the sunset means. In this example here, you could give away an additional $6 million. It grows to $19 million, and you could save federal estate taxes of at least $7.6 million. So again, there's a number of strategies in there with other trusts. There's charitable trusts, there's foundations, there's family limited partnerships. I mean, it can get very complicated, but there are ways to shield some assets and save some federal estate taxes with proper planning. So again, one of the questions that we typically ask: when were your estate plans done? And if they are old, I think it's a good idea, money well spent, to go ahead and get those tweaked, or at least get someone to look at them I'm worried, or we're worried when people walk in with no will. We're worried when people walk in with a handwritten will, although that's called a holographic will, and that will work. Or we are really worried when people walk in and their will is over 5 to 10 years old and things have substantially changed. Not fun to go to the doctor, not fun sometimes to go and talk about death and disability, but it really, really needs to be done. So word to the wise in our recommendation. Also, the new 10-year, we talked about the 10-year rule on inherited IRAs. In other words, you inherit an IRA from someone other than a spouse. Spouses who can still stretch are those who may be in a lower tax bracket when inheriting the IRA. Make sure of your beneficiaries. You've got different ways per stirpes, per capita, and those do make a difference. You've got different ways that accounts can be titled. That makes a difference. But how do you become tax efficient on the timing of your IRA distributions? You take out money 2 years, 4 years, 6 years, 8 years, 10 years. You wait until the end of the 10-year period. Do Roth conversions make sense? A lot of different peculiarities that would go into your individual situation. And so by laying all this out on paper, by looking at how the, if you will, the water would flow, the assets will flow, then we can help make better sense of that. Some people may consider leaving their IRA to a charitable trust. Life insurance, an excellent way to leave income and estate tax-free legacy to the next generation by the use of an irrevocable life insurance trust. So the investments are connected to the planning are connected to the estate planning. And again, if you do it all right, all correctly, you have a holistic plan that works very well. And we talk about in our planning that we want the 3 C's. We want clarity, we want comfort, we want confidence. And again, this is what our ultimate goal is, to make sure that you are aware of where you are, where you're going. And again, you have that comfort, clarity, and confidence, which we'll mention again in just a few moments.
And our last slide here on some information, and we'll talk about how we can help you potentially tile these moving pieces together in a more cohesive fashion. We think the estate planning involves more than just taxes. Depending on if you still have children that are at home, you're going to need at least 4, maybe 5 different documents. You need wills. You'll need the durable power of attorney. Randy mentioned durable power of attorney for healthcare. Usually there's a living will talking about don't keep me hooked up in a machine for a certain period of time, and then some attorneys will draw up a separate power of attorney document for health care. You still have children that are minors. You'll have guardianship papers as well. That can be actually the hardest decision to make: who would watch or who would raise your children if you and your spouse were not here. So with that being said, we've talked about a lot of information. We've thrown a lot of things out there as a few different tricks of the trade. Our Live Well plan is what Randy mentioned, the comfort, confidence, and clarity, what we're looking for each one of our clients. And so you might be thinking, well, a few of these things sounded interesting. How does it apply to me? Well, to figure out how it applies to you, what we would recommend is creating a Live Well plan, whether you're already retired, still have a few years to work, whatever your case might be. But this is how we can make this very personal for you.
So we talk about retirement not just an event, it's an ongoing process. And if your plan is not written down, it's not a plan, and it's certainly not a meaningful plan. But we like to think of a retirement roadmap. We find some people that have made these elaborate vacation plans or house plans to build a house, and they've spent hours and hours with the architect, or hours and hours with the hotel, the cruise ships, the airlines, and but yet on their retirement, they're sort of flying by the seat of their pants. So everybody wants to know the following questions: how much can I spend during retirement? We haven't yet anybody yet that says, I want to run out of money during retirement. How long will my money last? We want to give clarity, comfort, and confidence with regard to that. What rate of return do you need during retirement? Just talk with someone who's a couple years from retirement, and I said, what kind of investor are you? And they said, well, my wife and I, we're really conservative investors. And I said, well, that's interesting. Your 401k is 100% stocks, and your other assets are about 98% stocks. And he said, really? And so anyway, you want to keep your finger to the pulse. If you want to work past a certain age, we want you to work past a certain age because you want to, not because you have to. And if you're within 2 to 5 years of retirement and the market or the markets, the bond market, the stock market would throw a curveball, you don't want to be in a situation where you have to work just to get back to where you were. So how do I invest your portfolio during retirement? Benjamin Graham said the best way to measure your investment success is not by whether you're beating the market, but by whether you've put in place a financial plan. And this is key, a behavioral discipline that's likely to get you where you want to go. That's our ultimate goal, is create a way for you to get there from here, to have clarity, to have comfort, to have confidence with regards to that. And again, we call it a live well plan. It's a little bit corny because we want you to live well. Everyone wants to live well.
And a big piece of that Live Well plan is we develop a personalized number for your family. We call it your family index number. What rate of return do you need to get from here to there? And there, it can be different for a lot of families, a lot of couples. We'll have some families tell us they want the check to the undertaker to bounce. They don't want their kids to inherit anything. We'll have other families who have a very specific dollar amount that they want to pass on to the next generation. And so we're always solving for these different metrics, and we want you to live into your early mid, or have a portfolio remaining into your early to mid 90s. And so very peculiar to your family. And our goal with this is we want to take the least amount of risk possible to achieve your goals. No one's come into our office and say, hey, we're about to retire and we just really want to take a whole lot of unnecessary risk. And so this planning process helps us determine how much risk you need and to take the minimum amount of risk possible to meet those goals. So we'd be happy on a complimentary basis to help you create a Live Well plan. If you would like, send either Randy or myself an email, and we can start that process. Very easy to start it, and at the very least, whether we end up working together or not, we think you'll walk away a more educated consumer about your current or future retirement. So we'll get a few questions on what should we look for if we are hiring an advisor. This would be our unbiased advice on what you should look for. I gave my wife this information and said, hey, if I wasn't here, if Randy wasn't here, these are the questions you should ask. This is what you should look for with an advisor. Are they a fiduciary? That should be a non-starter in our humble opinion. If they are not, if they're not, they're representing possibly someone else and not your best interest at all times. Do they have a cost structure that's transparent, that you can understand? We think experience really matters. On top of that, you want to know what type of succession plan does the experienced person have. You don't want to hire someone and they end up retiring 2, 3, 4 years down the road. So having a succession plan in place should be something to consider. We think a team is much more valuable than one individual. Here at the Price Group, we have a team of 5 people supporting the families that we serve. Randy uses the analogy, if you have a heart issue, you don't want a doctor that looks at gallbladders on Mondays, big toes on Tuesdays, and hearts on Wednesdays. You want a guy that specializes in hearts. And same, we think, is true with retirement. You only want to retire once, and so you want someone that has helped hundreds and hundreds of families retire, and that has a real niche in that retirement area. And you want someone that you have a personal relationship with. You're not a number. Asking how many clients that person has is a good question to ask. And you never want to feel like you're just part of a cookie cutter strategy. How personalized, how tailored is it for you and your family? And then the last one's fairly obvious. Can you communicate with them? Some people click, some do not. Can you understand what they're saying? Are they using a lot of industry jargon, buzzwords to potentially try to impress you, or do they speak in terms that you can really understand?
So we appreciate your time. That is the Price Group there. Our tagline, everyone needs a wealth coach. We firmly believe that. We're passionate about doing the right thing. As a fiduciary, we think the planning process is the foundation of a successful retirement. And we think that should encompass your number one goal if you're within 3 to 5 years of retirement, is making sure you get things in process, you get things lined up. Feel free to reach out with us with any questions. We're real creative in our emails. Randy.price for my name at stewardpartners.com. That's Steward with a D. Matt.price at stewardpartners.com. And we'd be happy to have a conversation with you, help you answer some questions. And again, if nothing further, if we haven't gotten any questions in the email so far, Matt, no questions?
No questions thus far, but
okay.
Thank you again, and y'all have a great evening.
Appreciate your time. Bye-bye.